Assalamualaikum warahmatullahi wabarakatuh. I am Nur Adiba. Today, me and my group want to present about Malaysian Financial Reporting Standards, which is the first is MFRS 116, Property, Plant and Equipment, and second MFRS 140, which is Investment Property. So, moving to the next, there are two companies that we have choose, which is YTL Corporated Berhad and WCE Holding. First, YTL Corporation Berhad. YTL Corporation Berhad is an integrated infrastructure developer with extensive operation in countries. The core business of the YTL Group comprise utilities, construction contracting, cement manufacturing, property development and investment, hotel internet-based education solutions and service. YTL Corporation is amongst the largest company listed on Bursa Malaysia Securities Berhad, is a component of the FTSE Berhad Malaysia Mid 70 Index. YTL Corporation has also had a secondary listing on the Tokyo Stock Exchange since 1996 and was the first non-Japanese ASEAN company to list on the Tokyo Exchange. The YTL Group is committed to producing world-class product and service at competitive price. This corporate philosophy has enabled the YTL Group to build up a growing customer base of more than 12 million customers globally over the last 30 years. Next is WCE Holding Berhad. WCE Holding Berhad is focused on the execution of the West Coast Expressway project by its 80% owned subsidiary. WCE Holding Berhad is an investment holding company. The company's segment include toll concessions, constructions, and others. The majority of the revenue is generated from the toll concession segment, which is engaged in the business construction, management, and tolling of the highway operation. The construction segment is involved in the business of construction contracting and project management service, and the other segment is engaged in the business of leasing and investment holding. In the property sector, the group has enjoyed success in the launch of its 1,879 acres Bandar Ribayu mixed development project located next to Kota Kemuning Shah Alam.
So next, I will explain about recognition, measurement and indentation for YTL Corporation. Property and equipment under construction come with additional costs such as those incurred from borrowing. Incurred obligation during installation means that any dismantling or restoration costs must be covered under property expenses. Subsequent costs are added to an asset claim amount or identified separately based on whether it is probability that they will bring future economic benefits to the group and whether their expenses can be reliably measured. The income statement displays all other repair and maintenance expenses that occurred during the financial year. And in 1983, independent professional valuator conduct a valuation based on the open market principle of certain freehold property and building, which was then used by the directors to revalue them. However, the transitional provision established by MFRS 116 Property, Plant and Equipment stipulate that there has been no update to the valuation of those property alongside the land plus equipment, hence they are still reflected at their previous evaluated amount less any form of loss incurred due to devaluation or damage. For WCE Holding, property and plant equipment replacement costs are recognized either separately as assets when there is probability that they will bring about economic benefit in future that can be accurately measured or added into current carrying amount. Beneath an asset, a functioning state for its instead use a fund for its cost along with dismantling and site restoration expenses. When calculating the expenses for such asset, one must consider all relevant expenditure such as direct labor and material costs but should not include internal profit. Only after paying expenditure incurred on asset along with any interrelated borrowing charge involved in addition to performing necessary activities required in preparing such an asset does the group initiate with capitalizing of borrowing costs.
Assalamualaikum warahmatullahi wabarakatuh. My name is Nurul Amina Janat binti Abdul Malik Faisal. So today, I will talk about the differences between selected MFRS and MPERS. The first difference is initial measurement, where MFRS are measured at cost, which it takes the price of exchange transaction into account, while MPERS it takes the initial measurement that should be made at cost on initial recognition and should take transaction costs into an account. The second difference is subsequent measurement, where MFRS are measured by cost model and fair value model. In MPERS, the fair value is calculated at each reporting date, and any change in fair value are reflected in profit and loss. Thirdly, the transfer and disposal. In MFRS, transfer are made to or from investor property only when there is a change in use, as shown by the first one is starting to develop with a sale in mind. The second one is owner occupied status is started. The third is the owner's occupancy has ended. And lastly, starting a working lease with a different party. In MPERS, the transfer from investment property to property, plant and equipment if a valid indicator of fair worth can no longer be obtained without exorbitant expenses or effort. This transfer when the investment property first satisfies property or make satisfy the definition of the investment solely to and from the investment property. Next, an investment property, where in MFRS it allows accounting policy to choice of either fair value through profit or loss and cost of depreciation in impairment model. In MPERS, entity must be using the fair value model. Lastly, a disclose for the first time adoption. In MFRS, when accurate cost information on the assets and liabilities is not available, a first-time adopter may choose to measure the investment property at its first value and use the value as the deemed out. While in MPERS and investment properties, pure GAAP revaluation at or before the date of the switch to MFRS may be used by the first-time adopter as the investment properties consider cost at the time of the revaluation.
Okay, to summarize, this task is about MFRS 116 and MFRS 140. There are many things we have learned about. There are many different between those both MFRS. A significant amount of new information that is relevant to the MFRS has recently come to our attention, which is MFRS 116 are tangible assets, and they are held for use in the production or supply of goods or service or rental to others administrative purpose and are expected to be used during more than one period. Okay, investment properties value at fair value biological assets associated with exploration and evaluation. Assets are all exempt from MFRS 116, which is the new accounting standard. For MFRS 140, according to our research, investment property and only can be classified as some buildings. A fair value model or a cost model can be used depending on the needs of the business. Okay, there are also some difference between MFRS and MPERS. They are closely related. Both can be different by some categories. For example, MFRS 116 can be different by MPERS. Action 17 for aspect, reparation and revaluation of property and plant and equipment. Then for MFRS 140 and MPERS, condition 16 can be different for aspect subscription, measurement, first time, adoption and disposal. I think that's all from our group. Thank you.